Hi, good day everyone. Welcome. Thanks for joining in today's session. And today we're going to talk about index funds. Now, before I talk about index funds, I wanted to give you a little bit brief on what is the biggest and greatest minds has to say about index and who are they and where do they stand as we speak. I'm just going to give you a specifics information so that you can be the best judge of yourself. I'm not suggesting you need to go with the index funds, but then I just put some facts so that for you to understanding in a bigger picture and bigger perspective. And as I had mentioned early on, that you need to take advice from the people who has been successful in those paths. So, I mean, end of this video, I think you will have that little bit of grasp on, who are these guys and what kind of businesses they're still doing it, and what are the lessons if they with going in that path, and then if they tell you with the experience of 40 years, 50 years, and with the age of experience, it's something that we should be able to look and review yourself again. And it's pretty much that gives you an overall picture of what the greatest mind has to say. So at the end of this video, I'm going to attach those clips which can give you a broader understanding of how it works. So let's talk about Mr. John Bogle. He's the founder of Vanguard Group of Investment, and he started that in 1974. Earlier this year, he passed away. So he managed about 4.9 trillion US dollars. I mean, as we speak, that is under the asset management. So pretty much, 4.9 trillion US dollars. And then I'll come back to you where is the country's GDP is heading to. So the company is about for 45 years of age. Now let's talk about Mr. Warren Buffett. Mr. Warren Buffett had started Berkshire Hathaway in 1956. So the company age is about 63 years, and he's 89 year plus counting. So that's Mr. Warren Buffett, and he manages up to on an average about, I mean, as it was in a last year data, about 700 to 800 billion US dollars. So he's the CEO of that company. And when we talk about Mr. Charlie Munger, he's a vice chairman of the Berkshire Hathaway, and pretty much you can see the interviews almost all together. So he's about 95 years old, and he's a vice chairman of the Berkshire Hathaway. And this company started in 1956. It's about 63-year-old company. Now, Charles Schwab is a Charles Schwab Corporation, which does under asset management, stocks, etc. Now, he runs the fund pretty much under the management about $3.2 trillion, and he's aged about 82 years as we speak, and the company is pretty much 48-year-old. So you look at their age and the number of years they're in the business. Now let's come back to the top 5 countries where their GDP is a gross domestic product. So United States is about 21 trillion US dollars, China is about 15 plus trillion dollars, Japan is 5 plus trillion dollars, Germany is 4 plus trillion dollars, India is about 3 plus trillion dollars. That's what the data says. So now look at these 3 plus trillion dollars, 4 plus trillion dollars, 5 plus trillion dollars. Okay, leave that aside. Now look at their asset managements, how much they are managing, and individuals under the company, of course, but then they're managing about $3.2 trillion, and this under management about $4.9 trillion, and is getting close to $1 trillion pretty much in a couple of years. So you see, I don't know if you still have a doubt. Instead of taking advices from who has never been succeeded in their financials, I think pretty much we can look up to and say, what are those suggestions and what did they learn? I mean, the advices they give you, the number of things they tell you, I think we should pretty much look at it, because, you can refer their assets, I mean, their individual, the value of their own personal wealth would be different for you to understand. But so this is an overall picture of it for you to understand, and then followed by the video clips which I'm going to put, which will give you, and they pretty much talk about, all of them talk about strongly index funds, So what is index funds? As I explained last time, and also in the last video of Mr. Charles Schwab, probably will have a little bit broader understanding on how it works, where it works. It pretty much works in everywhere is the same thing. So this would be able to give you an overall picture of it. And again, I'm not suggesting that you should go to the index funds. You do your research, and this is for you to educate yourself. But what are the biggest top guys are saying about each index funds, and what, like for example, if you watch Mr. John Bogle's video, and it was there was a video clip about 1990, and then when he is almost about 85, 86 year old, and what he says. From that time also, you see he never changed his opinions. He believed in it, and then he stick to it, and then that's how I think pretty much they did it well. Again, this is all long term. Now, if you're looking for a short term, it's you do your own research and then find what best fits you. But if you're definitely looking into the long term, index funds is what this great minds has to suggest. You do your research, you find out, and after watching this video, I hope that makes sense for you. Stay tuned, stay blessed, and get educated on financial freedom. Thank you once again. Enjoy the clips. Thank you.
Actually, the 1942, when I bought my first stock, as an illustration of all the things that have happened since 1942. We've had 14 presidents, 7 Republicans, 7 Democrats. We've had world wars, we had 9/11, we had the Cuban Missile Crisis, we have all kinds of things. The best single thing you could have done on March 11th, 1942, when I bought my first stock, was just buy an index fund and never look at a headline, never think about stocks anymore, just like you would do if you bought a farm. You just buy the farm and let the tenant farmer run it for you. And I pointed out that if you'd put $10,000 in an index fund that reinvested dividends, and I paused for a moment to let the audience try and guess how much it would amount to, and it would come to $51 million now. And the only thing you had to really believe in then is that America would win the war, and that America would progress as it has ever since 1776, and that American business, if America moved forward, American business would move forward. You didn't have to worry about what stock to buy. You didn't have to worry what day to get in and out. You didn't know the Federal Reserve would exist, whatever it might be. And America works.
Retail investors have not come back into the market in great form since the 2008 downturn. They haven't been back as quickly as institutional investors and hardcore traders. Do you think that they are doing themselves?
The whole market is more institutional than it used to be.
But are retail investors doing themselves a disservice by not being involved?
Well, I think the ordinary investor who actively is trading with the help of the ordinary stockbroker is going to get a result which is way worse than the market provides.
You mean just indexes, investing in index funds?
Yeah, I just think the people who listen to CNN and want to be do-it-yourself investors, averaged out, they're going to be losers.
So what should they do? Just follow the indexes?
Well, if you don't know very much, you should buy an index. And knowing enough to make alternative conduct safe is something that's always going to be a minority sport.
What about the idea of staying out of stocks and looking for alternative investments because they got burned by the market overall?
Well, that's a natural thing to do. But what we've always tried to do is to be just the opposite. In other words, when everybody is totally discouraged and think the world is going to hell, that's when we like to be buying.
We're joined this evening by a mutual fund executive whose words are so clear they never need dissection or analysis. He's John C. Bogle, founder and senior chairman of the Vanguard Group, the nation's second largest fund company, and he joins us tonight from Philadelphia. Welcome, Jack.
Thank you, Tyler.
Nice to have you here.
Always good to be with you.
Great. You know, your Index 500 portfolio, now the second largest fund in America, has $55 billion or thereabouts in it as of the end of last month. Do you worry that so many investors who have put so much money into that fund over the past few years are going to be disappointed Not when that fund doesn't perform as well, but when some other index fund that you own starts to be the one that everybody wants to be in.
I worry about it a good bit. People should take an index fund for what it is, Tyler. This is a large cap-oriented fund. There will be a time when small cap and mid cap funds will do better than large cap stocks, but it's not here now. And to my delight, it wasn't here in the decline. The index fund gave a wonderful account of itself when the market went down mid-July to the end of August.
Hey, Mr. B, Bill Griffith here as well.
Hi, Bill.
What about the big picture, though? I mean, you, more than anybody probably in the mutual fund industry, have been a proponent early on of index mutual funds, and people lately have been buying into them. But what about the concept that if we see a market continue to decline, that people will be disappointed in all index funds because they find that the managers are not allowed to sell to get out of the market?
Well, the fact of the matter is that the index fund has traditionally carried about 20% less risk than the average fund. In other words, for all the vaunted ability of mutual fund managers to raise cash, they've really been doing just the opposite. They had 14% in cash at the beginning of this bull market and 4%, only 4% at the peak. They were bearish when they should have been bullish and bullish when they should have been bearish. So the index at least steers a steady course.
About mutual fund fees, how most people are happy to pay them when the market's going up because they're still making money, but as the market comes down, and especially as the net asset value of a mutual fund comes down, people maybe start to pay more attention to those fees, something that I know is very near and dear to your heart.
Yeah, the fees in the mutual fund industry, I'm sorry to say, are generally pretty outrageous. And you add to an average fee of 1.5%, at least another 0.5% for the fund transaction costs inside the portfolio, which isn't disclosed separately. And then mutual funds are tremendously, except for index funds really, tremendously tax inefficient. And the index fund is going to pick up another 1.5 on tax efficiency.
You think they're going to have to come down, though, because of competitive practices and because maybe fund investors will demand it?
I think sooner or later fund investors will see the light. You see more attention paid to cost in the press. You see more dissatisfaction with the mutual fund as an investment medium in the magazines, on television. And I think the industry's got to adjust to a different era. The fees are too high, and that's all there is to that.
And for my grandchildren, I put a little money away every year and put it in a balanced index fund. And it makes it very easy. They all have the same accounts, they all have the same amounts. And if nothing else, it's really convenient. And it does fine. Should I have it all in the S&P 500? Sure. Why stop there? Why didn't I leverage it for it? But I don't want to fuss with it. I don't want to think about it. I got better things to do, and they have better things to do. And the others, my son is a hedge fund manager, and he manages his own money, but he owns a lot of index funds.
Instantly buy an S&P 500 low-cost index fund. Keep buying it through thick and thin, and especially through thin, because the temptation gets, when you see bad headlines in newspapers, maybe to say, well, maybe I should skip a year or something. Just keep buying it. American business is going to decline over time. So you know the investment universe is going to do very well. The Dow Jones Industrial Average went from 66 to 11,497 in 1 century, and since that century has ended, it's more or less doubled again. American business is going to do well. The trick is not to pick the right company; it's to be, because most people aren't equipped to do that, and plenty of times I make mistakes on that. The trick is to essentially buy all the big companies through the S&P 500, and to do it consistently, and to do it in a very, very low-cost way, because costs really matter in investments. If returns are going to be 7 or 8%, and you are paying 1% for fees, that makes an enormous difference in how much money you have on retirement.
At the annual meeting for Berkshire Hathaway this year, you introduced a special guest to the audience of 40,000 shareholders who were watching. It was Jack Bogle. Why did you want to recognize Jack Bogle?
I think Jack Bogle has done more for American investors than any other person connected with Wall Street or the investment process, because he, with a number of other people, he came up with the idea of the index fund. He wasn't the sole thinker behind it, but he was the guy that implemented it and crusaded for it. But now there's trillions of dollars in low-cost index funds. Those people are going to have better lives. They're going to have better retirements. Their kids are going to inherit more money because of Jack Bogle.
Each month to put aside, and where should I put it? My recommendation is to put it in an index fund, particularly as a younger starting investor. One of the great features of index funds and broad-based ETFs is that you get the advantage of broad diversification. You get many stocks. So if you, let's say, invest in an index fund, there's some with S&P 500, there'd be 500 companies. They represent about 70% of Americans' value of stocks. We have a fund called the Schwab 1000. It's 1,000 stocks. It represents about 85% of the company's value in the United States. That is, of course, very broad diversification. And so if there's one industry that goes up, oil, for instance, and another one going down, utilities going down, you have an investment in every major sector of the economy.
Choosing the companies and industries that will deliver the best earnings growth is a real challenge. Competitive trends, management's ability to execute on their plans, and unpredictable events make it very hard to forecast results with success and consistency. Most people just don't have the interest, time, or expertise to pick individual stocks well. Multiply that effort by the many individual stocks you'll likely need for a well-rounded portfolio, and the complexity adds up quickly. Research shows how difficult it is even for the pros to actively buy and sell individual securities and match the market's performance. So to get the best chances of building a portfolio that is designed to grow and to get invested in as many different companies in as many different sectors as you need to be well diversified, what do? One of the easiest and low-cost ways to get invested in as many companies as possible is to invest in a mutual fund or an exchange-traded fund, an ETF, to own a basket of companies. And a smart approach to that is index investing, which provides two important advantages: diversification and minimizing costs. When it comes to investing, controlling costs is important. In fact, it's one of the few things you can control. Index funds are typically low cost compared to either buying stocks individually, where you pay a commission for each purchase or sale, or investing in actively managed funds that pay managers to choose stocks and make trades. Lower costs mean more money stays working in your portfolio. And over time, this can have a big impact on your outcome.
To me, there's lots of confusion in the discussion about investing, and you want to make it simple.